Jack, I'll start with you. What is your expectation from the Fed later today? And is the market ready for what we get from Powell when he talks?
I think the market's ready for some. It's not ready for all right now. I think we are definitely going to be getting an interest rate cut, federal funds rate, 25 basis points. I think we will probably see a cut to the interest on excess reserves rate by perhaps a little bit more. And I wouldn't be surprised if we saw a restarting of some sort of quantitative easing, at least in the form of open market operations. The thing that I think people may not be totally ready for is that it wouldn't surprise me a whole lot if Jay Powell comes out there and takes a hard stance on this being the last cut of this mid-cycle adjustment. Markets are pricing in more than that, and I don't think they're going to get more than one more cut.
Burns, do you agree with that? Especially when you see some of the data we've had in the last couple of weeks. It's been not as bad as feared. It's been better than expected.
The data has been strong enough that it certainly doesn't justify a 50 basis point cut. Really, the economic data probably doesn't even, in the near term, justify a 25 basis point cut. But because the Fed has said they're going to make the cut, and because you do need these insurance cuts, we do expect a 25 basis point cut is almost absolutely going to happen. And this is really one of those instances where they say actions speak louder than words. Well, in this case, it's actually probably the reverse. The action is what we know is baked in, but what makes a lot more difference is what Chairman Powell's words are later on. And we probably expect him to, if anything, have a little bit of a dovish tone, not mention any mid-cycle adjustments this time, and just make it very clear that the Fed is ready and prepared to do more without necessarily committing to a timeline.
Jack, does the attack on Saudi oil production change anything?
I don't think it changes a whole lot. I mean, we've already seen 50% of production back online within a day. I think the Saudis are well in control of this. And I think what's important to remember is that if for some reason this does extend into a longer duration problem, the U.S. has plenty of capacity to up production, push prices down, and resupply the market.
Some discussion this morning on the repo squeeze. Goldman saying we do not believe this widening is a precursor to a period of financial market stress driven by technical factors. We've been asking whether or not we're going to get some clarity on this from Powell today.
It's something that the Fed, it's already a challenging day for investors anyway, even without this. And so the Fed, they have a lot on their plate. Chairman Powell probably will address it. I think he's probably going to try to reassure the markets, let them know, this is technical, this is shorter term in nature. And, in layman's terms, it really just has a lot more to do with the fact that we are at the end of a quantitative tightening cycle, and that it's just you have a lot of window dressing that does take place at the end of quarters. But it's not something that's probably going to be a primary focus of Chairman Powell.
So, Jack, given expectations around the Fed this afternoon and beyond, given all the geopolitical stuff that's playing out in the world right now, and then, of course, these trade talks, which we'll see what happens there, how do investors need to be positioned?
I still overweight to the equity side of things, but I think that especially if the Fed comes out a little bit more with that hardline view, we're going to see some of the more defensive sectors perhaps take a little bit of a beating. Think about things like staples, think about things like utilities. I don't know if that's where I would be positioned right now because I think they may have been bid up. Still room for risk, but opportunities are a little bit more challenged.
Burns, I'll put the same question to you quickly.
Within equities, we think that right now is because we are late in the cycle. We expect investors to probably do best focusing on companies with visible earnings, companies with clean balance sheets. We really like companies that are growing their dividends. Dividend payers in general have gotten a little bit bid up, but those that are growing their dividends and compounding those are probably a good place to be invested right now.